It's my absolute pleasure to introduce Kristle Romero Cortes for today's seminar. Kristle's going to be talking to us about banking and resilience, integrating climate risk into banking stress testing, his work with Mandeep Singh at the University of Sydney. Kristle is Associate Professor in the School of Banking and Finance here in Business School, and her research interests include financial intermediation, empirical corporate finance, entrepreneurial finance, and the structure, optimisation and regulatory practices of the financial services industry. Dr. Cortés previously worked for the Federal Reserve Bank of Cleveland, where in addition to her research took part in the Federal Open Market Committee process. Her work's been published in the Journal of Financial Economics, Review of Economics and Statistics, and the Review of Corporate Finance Studies. And Kristle has a PhD in finance from Boston College and a BA in Economics and Philosophy from Northwestern University. And Kristle's been a great collaborator already in ICRR, and has been really sort of championing the role of the School of Banking and Finance in connecting with us in ICRR, and I think that's a great initiative. So I'm hoping that this presentation generates a bit more of that connection and discussion across the faculties and with colleagues in the different parts of the Institute for Climate Risk and Response. So I'm looking forward to the talk. Over to you.
Fantastic. Well, thank you very much for coming today. It is an excellent time to be here, and I'm going to have a lot of fun because, as Ben mentioned, we know the ICRR is interdisciplinary, right? So we have people from lots of different backgrounds, and in the run-up to this project, I've talked more with scientists than I had in my entire life, and I realize I enjoy science, I love science, but science is a hard slog. So they're very precise, and I think I learned a lot from going through that exercise. What I definitely learned, though, was that within our world of finance, we're quite comfortable with what we do, and translating that sometimes into other languages and other disciplines, it comes at an uncomfortable feeling. So we, and I say we because this is a joint project with Mandeep Singh, who did his PhD here at UNSW and now is at University of Sydney. And our conversation started first with presenting kind of a background of this idea, and eventually what we're going to be looking at is merging even something I don't do in finance, which is asset pricing. So everyone that knows me knows I study banking, and I've put stress tests into fruition during my time at the Federal Reserve, and I've actually used the data afterwards in research projects, and I appreciate that entire world of stress testing. Now adding to that component something to do with ways to kind of estimate better some of these measures, and then lastly using the data from specifically temperatures, and so kind of more of a science focused on the underlying data, was a lot of different ways of interweaving learning across those different potential fields. So this isn't our work, this is from the NYU V Lab, which we're very comfortable in finance, but basically the idea is volatility is constant, right? There's always things that are being changed, right? This is the most recent kind of graph of the global system. As you can tell, the reds are shaded darker, things are a little bit antsy in a few global economies right now, right? The V Lab, what they've done is they initially started at looking at just very stereotypical measures of volatility and risk in the stock market. And then they said, okay, this is a way to kind of present this. This is decades old. I remember this being presented to me in grad school, okay? But what they've done since then is they started to see during the financial crisis, we had this, deep desire for understanding better systemic risk. So saying that now we have all of this volatility, but what does it really mean? Does it mean we have to be changing something? We saw Basel III came in with a lot of changes because of this, okay? So, and you can go to the next slide. Truly, you're going to get the best, almost slides-free presentation that I've ever done. So our research questions in this paper were specifically, how can we actually measure climate-driven risks for banks, okay? And then the second one and then what are those implications for actual functioning, such as lending and deposit taking. Look, the first part here is not trivial, right? Because we've already talked about there's physical risk, right? We all get hit by a tornado and our house is demolished. We have the transitionary risk where now we're moving all of the investment into a different industry and I'm exposed to the industry where the investment is decreasing. Does this now translate to the fact that like my investments won't pan out, for example? But the vulnerability in the banking system, like I spoke to before a little bit, is the fact that if there is a degradation of faith in financial intermediaries, then this can cause either bank runs or reputational concerns. And the last piece that we kind of underestimate, but not so much here in Australia, but definitely worldwide, is the bank's exposures to real estate in terms of through their mortgage portfolio or through their actual collateral, okay? And so banks have a lot of skin in this game, but for whatever reason, they're kind of forgotten about. I think the science is cutting edge. We're looking at batteries, we're looking at solar power. You're looking at the bond market trying to do our green bonds. You're looking at ways to have some sort of understanding globally of this risk. And of course, this means agreements politically, and there's a massive amount of geopolitical disagreement over this, right? So they're just kind of plodding along, and in the meanwhile, right, they're on the recipient side of what could potentially be happening. Right? So data is the big problem. Do we have the data to measure however these global banks or intermediaries are going to be affected? And then if we do have the data, do we have the right measures? So I spoke a little bit before about the NYU V Lab. There's other papers out, so I'll definitely make sure it's not like we're the first people trying to measure this systemically, but a lot of those papers, specifically within finance, are using financial metrics and then trying to apply it into climate. So we think the contribution here is that we're starting with science as a data, right? We're taking the scientific data, which we've talked to a lot of scientists, we're pretty confident we have the right temperature data, but for a lot of people's point of view, temperature is a safe data set to use, right? So measuring temperature, a lot of people believe in the temperature data, right? In the sense of like, we have it from the CETA data source, the CRU from East Anglia, which I believe is, everyone accepts in terms of understanding that these are great metrics. And now we're going to use some of our financial measurements to actually incorporate this data, okay? I'll take the next one. Right. So if you don't know what a factor model is, no worries. I didn't really either. If you do know what a factor model is, you can, enjoy a beautiful kind of cloudy-ish day for 2 or 3 minutes. But essentially, this is the asset pricing piece, right? So if you have finance, you have asset pricing, you have corporate finance, and within corporate finance, maybe you're a little bit to the side askew is like banking, right? So my whole life had been dedicated to the field kind of, orthogonal to asset pricing. But what is happening here is that we take actual stock market data and then back out some information, right? That's what we're doing in finance with the asset pricing models. In our paper, what we're going to do is apply a factor model, which is very much similar to just moment matching in science, right? And use the temperature data and then back out temperature, underlying factors from the temperature data. And then go and kind of make these bridges into the other metrics that we use. So the temperature data, effectively what we're using specifically is, we can use global data, but the banking data in the US is much richer than we could get globally. So we have localized temperature data in the US. We use 3,200 counties that are done by their gridded metrics, and we use their abnormal temperatures now going back roughly 50 years, right? And so what this gives us is the first 4 factors, which are pretty much the main bulk of them, give us then the 60% worth of being able to understand the underlying abnormal temperatures across the US across this time. Right? So this is, a correlation right, matrix that we're backing out this information from. Inverting this matrix actually takes some computing power. So doing this, especially at that level, the gridded level we're using, is backing that out. Took some time, which is why we're very happy to even report the factors. But then beyond that, we're going to continue using what the other metrics are. So the factor model piece is, really the wheels of getting this started. And again, that is credited to Mandeep's work, and he's worked in this before. And now we're going to look a bit at the implications of it. Okay. So now, what we're going to try to do is do something called estimating our betas off of that factor, right? Again, in finance, this is something we've seen a lot. We've talked a lot about this. We have this as very kind of finance 101. We teach this in our classes, right? But the climate betas then are actually giving us these weights to these factors that we're going to extend to the real stock market data of all publicly traded banks in the US. Right? So we're going to spend just a moment to kind of walk through this a little bit. Again, we have the temperature data, which we've spoken with the scientists. We feel very confident, this underlying temperature data. We picked the right data set, right? I still don't know how to do the acronyms. I don't know exactly if I should call it SATA or CRU or whatnot or spell it out. But there is a sense where now what we do is we take this rolling window of the actual returns that we receive in the stock prices of all the banks in the US, and we're backing out from there these exposures to these betas. Okay? So there's no real economic, we've attributed some economic intuition to factors in finance, but in terms of factors for temperature, there's no real intuition to be what is the building of this. We just say we end up with 4 that kind of explain 60% of it. It's relatively kind of straightforward, but we do that already. And the factor model piece then gets us to the next stage, which is these betas. Right? So we have these rolling window betas, and we follow the estimate in order to back these out. And then what we're able to do is try to now get to the nitty-gritty of understanding how to better model actual stress testing, and then give some sort of advice on the implications to the banks themselves. Take that. Okay. So these are our climate betas if we're looking at them for density plots over the 4 different factors. Right? So what you can tell from this is that, first of all, they're very much centered at 0. Right? So we have a robust system that we don't look like anything necessarily is very skewed at the first part. So this is great because this confirms kind of what is our expectation in terms of how the models were supposed to behave. Okay, so it translates into, that confirms some of our initial priors, right? Now, the thing that's kind of important to understand when you're looking at this is that this is a whole system at play, right? So we're going to look a little bit, we're going to drill down into the specifics of what this could mean for individual banks. Just going to take it. Okay. So our factor analysis over a time span basically gives us the understanding that these things definitely change, right? And there's more exposure or less over time. Right? So the actual factor analysis, right, is kind of backing this out from the temperature data, and then the betas themselves are doing the weights on this exposure to the actual factors from the temperature data. Right? It's clear that there's movement. What isn't really clear, again, is any sort of economic takeaways, right? So, what do we learn from, understanding that there's movement over time? The first thing is that you can tell that specifically in times of, this is a bit like when you're looking at the global financial crisis, that there is actual price movements in terms of what could be considered differences across the different 4 factors, right? And the really difficult part is we don't have something we can grasp onto to kind of give you some sort of antidote here, to really be able to say, okay, well, what is this? It seems like a lot of math in the background, but what does it really mean in real life, right? But the reason that we avoid that is because by not putting some sort of paradigm on this system, we can let it move over time, as it's going to naturally, right? There is an underlying kind of premise in finance, which is that information is priced into the stock market. Not everyone loves this, because there is a sense of, well, that assumes that humans are rational, and if you've looked at, the last few weeks of behavior, humans probably aren't very rational. But we have to abstract again away from that, and we can say, let's go with humans are rational in the sense that at least when it comes to their money, they're going to take all the possible ways of getting all the information, and they're going to translate this into actual movement, and we see then movements in, stock prices, okay? And then you can kind of back that up. Jerry, yes?
So, even without committing to a model, right? So, how can we, as lay people, put some words behind, if we think about momentous events,
yes.
2 crises
yes.
that we can think of, 97 and 2007, and I think we can tell that the
first factor,
the factors
yes.
are rising,
yes.
slightly prior to the crisis and then peaking.
Yes.
What does that tell us?
Yes. All right. Well, without the paradigm, right, there is a sense of attention to these banks and their potential actual portfolios and their behavior means that the exposure to climate gets picked up, okay? So in times where people are a bit laissez-faire, they're not paying any attention, then climate gets swept under the rug like pretty much everything else. The moment, though, that there is some chatter, right, and now people pay attention for some reason, climate becomes more first order, right? And this is one of the things we'll talk about in terms of how to bank on resilience, is that it's obviously underlying like all of this kind of decision making, but until people's spotlight is on that, they can kind of get away with it, right? Now, if you start to break down the data a little bit, you're right that the lead up to both of these looks a bit like you're able to forecast that something's going on. And that, I think, comes from the fact that there's always some mutterings, there's some red flags, there's, one thing isn't able, there's a bit of a default someplace or a small something here, and it builds up, and then our system eventually kind of reacts, right? But that's the takeaway, is that when there is focus, there is actually much more of the weight than put onto climate as well. And I think another thing to kind of note is that this goes back now to 1990s. Right? I mean, we're very much in the world where we feel like climate now, there's focus on it, and maybe in 2001, there was some kind of a big push for it, right? But obviously, in Kyoto, there was a sense of trying to make this much more first order, and that piece, I feel like that is an important lesson for bank systems now as well. Like, we're going to find that systemically, banks are still very robust, but a lot of that comes from the fact that we've been through enough crisis where they're required to have this capital on hand, right? And the fact is, there's going to be places that they can have room for improvement. So it starts to be a bit about, well, unfortunately, we're doing a lot, but we probably have room for improvement on the climate front. So now there's a bit more of appreciation for what this means in terms of the actual movement. The other thing that I want to draw some attention to here is that obviously, I mean, these are bands, so you can see them like 90th, 95th percentile bands. You're seeing though that certain banks are above and certain banks are below. And you're also seeing, it's kind of hard to see here, we'll see it on one of the next ones, that the marginal risk is narrowing a little bit. So it's bringing like, you know, the extremes kind of closer together in terms of like, there's just understanding in the banking system of what is going to be the path forward. So we're trying to get a little bit of a narrow, like, fewer extremists in terms of the best behaviors and the worst. Even best practices, you know, are similarly being shared. Yeah.
I'm so sorry to ask another question, but is this just using US banks?
This is right now.
Okay.
Yeah. So we've had analysis. We do have analysis with Australian banks, but the Australian banking system, the data we don't have as much data on. And also when we do that, we use global temperature, right? So if everyone's fairly aware, in Australia we have our big four banks, and they all operate in exactly the same places. So it kind of means like, what does that really translate to for different exposures to temperature, right? Because they're in the same areas. But Bendigo Bank is a bit of an outlier, but the rest of them are all kind of like right on top of each other. Climate, as we know though, doesn't stick to one country. It definitely, you know, it incorporates everybody globally. But the underlying data for this exercise is the US, and I'll talk a little bit more about doing, right now it's all publicly listed banks so that we can get their stock prices, but we're also keen to do something for private banks.
So I guess the reason why I asked that question, that's interesting as well, is, you know, can your story be explained by just a substitution from these banks that were investing in these brown industries, let's say, to foreign banks and domestic?
So we'll have a systemic risk graph that's coming up, but so I'll probably answer that a little bit more in detail then, but what this is really talking about is the exposure to the climate risk in this system. So if there's a sense of, well, there's still climate risk globally, yeah, okay, that absolutely could be understood, but in this system, kind of the takeaway is the fact that our factors work, our betas work, and we can see that there's updating, like, behavioral changes. Maybe I'll get the next one. It maybe helped to see that if we calculate marginal climate risk, right? So while that was a stable understanding a little bit of just climate risk exposure, this measure effectively has that the climate stress is independent from the realized undercapitalization of the market stress, right? So I'm going to go to the graph on the next one, so that we end up with, all right, so marginal climate risk or marginal C risk, this is trying to take away something, which was to say there's already exposure to risk in the system. How much of it is just due to climate risk? You know, so there is this sense of, well, you know, we've kind of bundled everything still together when you look at climate risk because we're just taking it off of stock returns, and stock returns are pricing everything in, okay? So this is to then extrapolate out the piece that's specifically we're measuring attributed to climate, right? And now we can see that that behavior was even a bit more, you know, it's a stronger experience. So still centering around zero, we had definitely a lot of movement during the global financial crisis because the underlying risk in the system was the fact that, you know, mortgages were under duress and whether or not there was going to have people, you know, default on their payments to their counterparties. And then the drop off here that we're seeing is back to the fact that now there is some movement overall. We've regulated it into existence somewhat that so much more capital has to be held. But these are the biggest banks, the publicly traded banks. They own a large portion of the assets class in the portfolio. But what it translates to is that you can see that, again, the actual component that is climate risk is decreasing. Okay, so there is a bit where we still have a lot of underlying risk in the financial system, but there aware of it now. They're not, like, in a way, when we were saying before that when there's a spotlight on the banking system, you know, a lot of attention gets driven, and climate obviously bubbles up because they weren't paying attention to it before, and now you should have been the whole time. But this is also something that we didn't know that this was going to happen. Like, we were actually quite happy to see. There's a lot more academic literature. There's many more people talking about climate. You know, we have amazing institutes being formed. But how much of that was translating into the behavior of the financial intermediaries? And it feels like this message is landing, so that there's now the sense of they can't minimize it completely. We can't necessarily get it where it's got to the piece that we can have understandably mitigated all of climate risk as it's continuously growing. But there is a piece where it's moving with some of that. So if the first point was, we already see it, there's a lot of capital in the system, and thus, banks are pretty robust. The second point is they're learning their lesson. So it is absolutely not the case that ESG is dead. Right? There is, some of this about what is a greenium and what is, whether or not this is going to be value enhancing versus revenue enhancing, if those are mutually exclusive. That is not true. The financial intermediaries are making this point very clearly that this is first order. They're going to be making lending decisions based off of this information. We hear antidotes of this, but this is really nice that we're able to back it out in the data as well. Yeah. Any questions? Yeah.
So that graph that you're showing, is that metric like a formula based on like capital and like stock price, or like how are you sort of plotting sort of the end dip at the bottom?
Okay, so just for this one specifically.
I guess also the
So the beta weighting that we got off of those 4 factors, right? They're being then applied for each of the individual banks and their actual stock returns. So their returns themselves that go back historically, we're looking at then their exposure to the weights for those factors. So capital is in there, and anything that would also be informing the stock returns. But in this kind of piece of that, what we're trying to do is remove any other systemic or potential risk that we expect to be in the system, to be able to focus specifically on the climate risk piece. Yeah. So with the stock return or any stock price, we see those movements. There's a lot of information there that gets priced in theory, instantaneously from any sort of earnings announcements or information, or if they're trending on Twitter or now X, any of that is supposed to get kind of updated there. Right? So their overall market cap is including all the sorts of things that you can explain to be controls in the system. Now, I understand sometimes that's a big order to sell to people because there's a sense of like, well, the stock market gets it wrong, or they don't price the things right, or look at Credit Suisse, it was fine, and then all of a sudden it was insolvent. And so that's a very legitimate concern, is that we would have the data based off of this analyst expectations and these earning announcements. If there's outright fraud, we can't see that, right? We wouldn't be able to measure that. And if there's kind of this complete albatross that comes along that we weren't expecting, like they didn't realize that house prices could fall in 2 different places in the same time, and all of a sudden they're actually linked, and it takes down an entire financial system. Right? That's true that there's that expectation, but that's for the entire system. Right? So the entire system would have those same potential caveats and flaws. Right? So in the way that we see kind of, we won't take off some specific number, but we feel very confident with the sign here. Right, so we see that the trend is decreasing. I wouldn't necessarily have to pick off one specific number and give it to you and hang my hat on it, but I could definitely see that the exposure, at least, is being reduced. And so there's that takeaway is in the data. Yeah. I'll take the next slide. Okay, So finally, we're getting to systemic risk. So systemic risk is fun. It's really straightforward in the sense that we need our banks, right? We need access to credit and capital to grow an economy. This is very well established. Right? We have hundreds of global banks. We have ones that are in hundreds of countries. Curiously enough, Australia punches way above its weight in terms of our banking system, especially if you look at Macquarie Group. So if you start with Macquarie in terms of a global bank, and then Westpac, and then we move on to both CBA and even NAB, we're in above the top 100 banks of the whole world, and obviously our population is not that. So it's really an interesting place to be here because we have like a very robust system that way. In the US, again, we have some very important banks, global banks that interact everywhere, and they are thus treated as globally systemic important banks. So if you're aware of Basel III, they put this in place to say these GSIBs, to say the fact that we end up with certain financial intermediaries that they need to be sound, they need to be regulated as if they're going to take down the whole global system if they do, in fact, fail. So we don't want to bail them out, they'd be way too big, right? So we end up with measurements of systemic risk. Systemic risk, though, was, 30 or so models were initially created to start doing stress testing, right? We did not just do this and be like, oh, let's stress test, right? This was extremely difficult period of time. And the big idea behind them is that you're supposed to do this cross-sectional sum across all potential risks. And in our case, we're using now climate risk and be able to posit this and put this into the systemic risk. That global graph that I showed you at the beginning from the NYU V Lab, what they're doing is very similar, right? They're effectively trying to give some sort of metric of systemic risk. To know, though, that the US right now is going through a time of anxiety, while it is true, it's probably not super informative. You probably know this already, right? So kind of now, what do we do with this, okay? So I can take the next picture. Right. So plotting what is actual exposure in terms of systemic risk with relation to climate risk means that here we are saying how much, we've looked at climate risk, we see that banks are trying to mitigate their climate risk, and that's good news, but it's kind of, work in progress. What does that mean for their systemic risk? Okay? Because I'm only going to be able to give them practical advice on what to do to reduce all of their risk, in terms of if we put an entire system. So the systemic risk, though, looks like it's nothing. So we have this massive spike with the global financial crisis, but otherwise, it looks like things are fine. And that's actually a takeaway of this exercise, is that, well, it turns out, when we're looking at this, with the respect of how does climate fit into what's going to happen to the global banking system, the global banking system is being stressed daily, right? And they're aware of this. They're also aware, though, that the movement in the right direction is to reduce this climate risk, okay? That's going to have knock-on effects to Eddie's point before in terms of who's going to hold debt and if they're going to be these global investors investing in brown versus green potential investment opportunities. That is absolutely coming down the line because there's the only way forward is really to continue to reduce this. But if you look back to the 90s, it's a little bit higher here. So what I'm going to do is I'm going to remove this. If you could give me the next slide. So if I remove that, hiccup in time where we took out the entire global financial system, it's not nothing. Okay. So when we now, you can tell here, I've changed the ability to measure this across the gradient, and what you can see is that in the 90s, especially when we had a little bit of some information reveal, etc., we're trying to get some things going geopolitically, like understanding if we can all come together and make a decision a little bit about the movements on climate, there is more stress and more exposure for climate risk and its effects on systemic risk. Now, we didn't talk about systemic risk back in the 90s. Right? This is very much at this point in time, there's still literature being written about like spillover effects of global banks. Right? This is almost just right after the US has done de-branching regulation, so they're able to now have branches outside of the same states, whereas before it was all just within a state. Right? So this is a movement towards deregulation in this period of time, and a lot of the sentiment was about what are going to be the long-term effects on other economies if we deregulate. Right? If we're able to lend someplace we weren't able to before. And we have the financial integration of lending, it means that maybe I could take my deposits from someplace that's not really well off or economically sound, and I can move them to someplace I know I'm going to make a lot of money. Right? So I'm going to be taking potentially from the poor areas and moving them into areas where I'm going to reap these higher returns. Right? So this is the world that they're living in then. Right? And obviously, systemic risk was not measured, but we can go back and measure what it would have been at this time. And it was definitely higher than when you start to get into periods where some higher, more stringent regulation comes on to look basically at this cross-global lending. Right? And that's the piece that eventually we kind of land with here, is that still, while it's getting to be a little bit lower, there's periods that, even removing the largest of our global financial system shocks, we still have relatively high spikes in systemic risk and in terms of getting this coming from climate risk. And I think these spikes are basically that understanding when, again, we start to put a lens on this and they say, oh, we haven't taken into account the fact that people or counterparties holding our debt are actually doing the same thing we are. So if we both experience this shock, we don't just take down one lender, we're taking down potentially a chain of lenders, right? Now, it's hard here though, because it's accurate to group the largest banks, those that are publicly traded, to be the ones that are the most systemically important, okay? But they're not the only banks in our system, especially in the US. So the US, 10,000 banks, right? And we know of the big 4 or 5, right? And beyond that, we have thousands outside of that that deal with the local lending, and those local regional banks handle the vast majority of the credit coming through those regions, okay? And the issue that was highlighted last year with the SVB crisis is that a farmer in Ohio cannot go to Manhattan and take out a loan from JP Morgan Chase, okay? They're going to be operating at KeyBank or PNC, someplace that's a regional bank that understands their business model, their risks, and grants them their loans. So we saw that lending was drying up because the regional banks were under duress, okay? And same thing if you're starting to look at commercial real estate. This industry is getting a lot of attention because of the potential of people to continue working from home, the fact of we have these little satellite cities in the US, which we don't necessarily have here, but people could live just as happily in Austin or Phoenix or Raleigh-Durham as they would maybe in Dallas or San Francisco or New York. So that means that there's a lot of movement. And what that translates to is that a very large spectrum in terms of financial intermediaries that kind of house all these different needs across all of these different creditors, the borrowers. When we look into other financial systems, so if you look at ECB for Europe, we have a much older set of creditors. If we look in Canada, UK, New Zealand, or Australia, we also have a different kind of portfolio for what people look like, what their expectations are for lending. Right? 60% of our asset class of our big 4 banks is actually in houses. So we have a much greater exposure to the physical risk, but it doesn't really vary across the big four banks. They're all really exposed. So what that wouldn't really then translate into a variation across the systemic risk. It would just basically say there is systemic risk, okay? So that's what it looks like when we get these spikes, right? These spikes is less about the, looking across the spectrum of the actual banks themselves, but the fact that they have this exposure. So I'm more or less, I think, on time. I'll take the next slide. It's just my final thoughts. I'm more than happy for people to contact me with questions afterwards. But the next piece of this is that we're going to move to those private banks. So we have the public, banks. We use the stock market information for them. It's very established in the financial literature that we have these metrics and methodologies. But to give some practical advice about those banks in the band above zero, about what they need to be doing to continue to decrease their exposure to the actual climate risk. Part of our intuition is that those may be the smaller banks. They're still the smaller publicly listed banks though, right? So they're big. But if we start to look actually at the private banks, and we can do this because we have the data available in the US for their portfolios, for their lending portfolios, and for their physical locations, then we can start to say, well, what does this mean for our everyday kind of creditors who aren't necessarily able to go to like JP Morgan Chase, right? And in terms of the title, Banking on Resilience, it really translates to the fact that a lot of this is planning right now because the climate is continuously warming, right? So there's more, the shocks will be bigger, they'll be more frequent. This piece is well established. So now there's a sense of if there is already some of the practical behavior changes, we can see that there's a reduction to this exposure to climate risk, right, which we've already backed out and we can show you. That kind of gives us a sense of the way to plot out best practices moving forward and kind of like to teach the lessons of what this looks like and what the best ways to continue down that path to reduce that risk. But there's still I've been to a few climate talks and relatively they're all surprisingly positive. Because meanwhile, things are tricky, but there generally is a sense where right now the way that the numbers show us is that while banks are paying attention to it, they can reduce that risk. And importantly, systemically, that exposure is just one more kind of layer. So as long as the banks are, kind of their feet to the fire on the fact that they constantly need to be robust to any sort of risk, they're going to have that capital on hand, right? Then there's a sense of, okay, this is one more risk we're expecting them to mitigate, one more or manage, right? And if they're experts in this, fantastic. The more pressure we put on them to do it, though, obviously the faster it will get done, right? And so I think that's a useful piece and takeaway from this, is that it really is about keeping that kind of rhetoric, expectation, understanding that if the borrowers want money, they're going to have to be showing their banks their attitude is to be changing in this direction as well. And I've heard that from our big four banks, and I've heard that abroad as well. So. Great, thank you very much. Any final questions? I don't know, people are very happy.
Let's thank Kristle.